there's relatively little expectation for any material policy change in terms of rates and bond buying as well. However, I think what the market's very focused on is whether there will be any changes to the Fed's forecast. There is clearly an expectation or an assumption that they'd have to raise their growth and economic activity outlook and perhaps lower their unemployment rate forecast. The big question, though, is what will the dots be adjusted to, if anything, to reflect rate hikes? Our assumption is that looking out into 2023 and 2024, you will see more Fed governors talking about rate hikes. And so the dots on an average term may start to tweak up a little bit, but we're not expecting anything for 2022. And as you say, we are expecting Powell to reiterate a fairly consistent pace of bond buying.
Sure, but what will that do for the markets? Because the rise has been fairly significant in the 10-year benchmark. Does the pace of rise continue or abate, depending on what the Fed says?
Yeah, sure. I mean, look, I would argue that 10-year yields would consolidate here for a bit. I mean, if you look at current market pricing, Tanvir, we've got nearly a full rate hike priced for the end of 2022, and we have a total of roughly 3 hikes priced out to the end of 2023. And so the market is pricing in a bit of an adjustment in the dots and in the Fed's outlook. If they were to validate that, I'm not sure the 10-year part of the curve would react too much to that. But we do know that U.S. rates markets have a tendency historically to price in the full rate hiking cycle before it even starts. And some of the longer dated forwards are starting to reflect that already.